January 2019, WeWork is worth $47 billion. 4 years later, zero. Same buildings, same desks. What actually killed it wasn't the market. It was one document nobody was meant to read too closely. It starts in 2010 in a single building in SoHo. Adam Neumann and Miguel McKelvey open a shared office space. Built on a $15 million bet from early investors, co-working isn't new. But 2 years after the 2008 financial crash, the idea lands at exactly the right moment. Freelancers and cash-strapped startups need desks, not 15-year leases. Neumann doesn't pitch it as real estate. He pitches it as something bigger: community, connection, what he calls a physical social network. It's a phrase that sounds inspiring in a pitch deck. It will also become the exact justification for a valuation that makes no sense, because eventually, someone with far more money than scrutiny believes that phrase completely. In late 2016, Masayoshi Son, the head of SoftBank, tours a WeWork office. The tour lasts 12 minutes. By the time it's over, Son and Neumann are sitting in the back of Son's SUV, sketching out an investment on the spot. 9 months later, in August 2017, it's official. SoftBank and its Vision Fund put $4.4 billion into WeWork, $3 billion straight into the company, another $1.4 billion into new regional arms in China, Japan, and the Pacific. The deal values WeWork at $20 billion on a business that mostly rents desks. From here, growth isn't a strategy. It's the entire plan. And the faster the company grows, the louder its culture gets. Inside WeWork, the money starts to show. Neumann is known for demanding cases of Don Julio 1942 tequila for company events. On his private Gulfstream jet, a flight crew reportedly finds marijuana stuffed inside a cereal box. His wife, Rebecca, launches We Grow, a private school built around the couple's language of elevating the world's consciousness. None of this shows up on a balance sheet, but it tells you exactly how decisions are being made at the top, on charisma, not discipline. A company burning cash this fast needs a founder obsessed with the numbers. WeWork has a founder obsessed with the mission statement, and underneath the mission statement sits a math problem nobody wants to look at yet. WeWork's business model runs on a mismatch. It signs long-term leases, often 10 or 15 years, locking in fixed costs for over a decade. Then it rents that same space back out short-term, month to month, to freelancers and startups who can leave anytime they want. In good years, that spread looks like a growth story. In a downturn, it's a trap. Long-term obligations funded by short-term, easily canceled revenue. Nobody at WeWork calls this a warning sign in 2018. They call it community-adjusted EBITDA and keep expanding into more cities, more buildings, more debt. For now, the story is too good and the money is too big for anyone to check the math. In January 2019, another SoftBank funding round pushes WeWork's valuation to its ceiling, $47 billion. It's a bigger number than most airlines, bigger than most hotel chains. Only about $1 billion of SoftBank's eventual $10.65 billion investment is ever actually made at that price. Everyone else who buys in is paying for a peak that's already starting to crack underneath. The crack goes public 7 months later in a filing WeWork itself has to write. On August 14, 2019, the We Company, WeWork's parent, files to go public. The paperwork is supposed to sell Wall Street on the dream. Instead, it exposes the machine underneath: a $1.9 billion loss on $1.8 billion in revenue. WeWork is losing more than it makes. Dual-class shares hand Neumann 20 times the voting power of a normal share. And buried in the filing, Neumann has been leasing properties he personally owns back to his own company, and had sold the trademark to the word "we" to WeWork for roughly $6 million in stock. Investors don't just see a risky business. They see a founder treating the company like his personal bank account. And once investors stop trusting the founder, the countdown starts. The fallout is fast. On September 24th, 2019, 6 weeks after the filing, Adam Neumann resigns as CEO, forced out by the same investors who once fought to get into the deal. Co-CEOs Sebastian Gunningham and Artie Minson take over a company now in freefall. 6 days later, on September 30, WeWork formally withdraws its IPO. In 6 weeks, the number the whole story was built on, $47 billion, has fallen to under $10 billion. A company chasing one of the biggest IPOs of the year has just become one of the fastest IPO collapses in modern history. Someone still has to stop the bleeding, and it's the same investor who funded the fire. In late October 2019, SoftBank steps back in, this time not to fuel growth, but to survive the wreckage. A rescue package worth roughly $9.5 billion gives SoftBank majority control close to 80% of the company. Neumann walks away with an exit package reported at $1.7 billion, a payout that draws public outrage given what he's leaving behind. Weeks later, on November 21, 2019, WeWork lays off 2,400 employees, 20% of its global workforce. The people who built the co-working spaces, the education arm, the apartment experiment, all expanded under Neumann without a real path to profit, are the ones who pay for it first. Stripped down and SoftBank controlled, WeWork gets one more shot at the public markets. In October 2021, WeWork goes public again. Quietly this time, merging with a blank check company called BOX Acquisition Corp. It lists on the NASDAQ under the ticker WE, valued at about $9 billion, a fifth of its old peak, achieved by skipping the roadshow scrutiny that sank it the first time. But the core problem never gets fixed. Expensive, long-term leases the company still can't sublet profitably. The stock bleeds out. By November 6, 2023, WeWork has lost 99.9% of its value since that NASDAQ debut, and it files for Chapter 11 bankruptcy, wiping out shareholders and shedding the leases that never made sense. The one person who refuses to let it end there is the man who started it. In 2024, Adam Neumann tries to buy back the company he founded, raising his bid as high as $900 million. A bankruptcy judge rejects it. His financing doesn't come close to addressing WeWork's roughly $4 billion of remaining debt. He withdraws his offer on May 28, 2024. Instead, a $450 million bid led by SoftBank and Yardi Systems wins, and WeWork emerges from bankruptcy the following month under new ownership. With a new CEO, John Santora, the founder who talked his way to $47 billion can't talk his way back into the building, which leaves one question. What actually broke here? WeWork was never really a technology company. It was a real estate business, borrowing long and renting short, wrapped in the language of a startup because that language was worth billions more than the business underneath it. For 8 years, one investor with almost unlimited money let that framing go unquestioned. It took a single public filing, the kind every company has to make honestly, to show the world what WeWork actually was. The real lesson isn't about tequila or private jets. It's that a growth story without outside scrutiny doesn't fix its own flaws. It just gets bigger until scrutiny becomes mandatory. For more real companies, real mistakes, and real consequences, subscribe to Business Failures.